Hello, everybody, and welcome to the weekly market update call for Monday, August the 10th. I'm Jay Gragnani, and here joining us this week is Steve Raymond. And thank you all again for taking time out of your day to join us for these calls. It's hard to believe now we're talking about mid-August, but as you know, as we've seen over the course of the past few months, we've continued to see improvement really across the board with respect to the equity landscape, to the extent that last week we did see another positive development as it relates for equities among some of our macro relative strength rankings, specifically Dolly seeing domestic equities or U.S. equities see notable improvement. We'll dig into that a little bit more in detail. Also looking at some things that are moving underneath the surface. We've seen some interesting developments across the asset class group score page, and specifically seeing a number of kind of the subgroups showing notable improvement here over the course of the past couple weeks, and in some cases the past couple months. So dig into a little bit there and see where some of these leadership trends are moving. Lastly, we did want to mention crude oil. Crude has seen a tremendous amount of volatility over the course of this year, and even going back to seeing May contracts for crude oil back earlier this year actually turning negative at one point. So crude has certainly bucked that trend a little bit here recently and has moved back into a positive trend. So looking at and uncovering some of that there is where we want to finish off. So with that said, we'll kind of jump right into it and look at just performance trends that we've seen not only over the past week but so far this year. And there's been some very clear leadership trends in the market. And gold on a year-to-date basis, GLD sitting right up there at the top of the performance, up over 30% on the year. A lot of that coming here with more recent performance. You can see over the past month is up about 12%. Outside of that, when you drill down and look at the equity space, the equity leadership really has been confined to a few areas. The S&P 500 through Friday is up just under 4%, 3.7 on the year. And those areas of the equity space that have done better than the S&P 500 haven't been a lot. You see technology from a sector standpoint up over 20%, consumer discretionary as well as consumer services are up there, and healthcare just outpacing the S&P 500. But it's really continued to be that growth-oriented theme. Factors like momentum, you see PDP up almost 16%, and sector rotation strategies like the Focus 5 up almost 10% on the year. Those two particular ETFs are relative strength driven, that are dynamic underneath the surface, that are designed to have the ability to rotate on PDP, looking at individual stocks, so finding leadership through individual stocks. Within FV, finding leadership through sector trends. And we see when you look underneath the surface of those, certainly the overweighted exposure towards areas like technology and communication and consumer discretionary as well have certainly benefited those strategies over the years. Over this year. The other end of the spectrum, and over the course of the past month, you see a number of sectors, specifically financials and energy, are still down double digits on the year, where most of the other sectors are still in negative territory again through Friday. And so that's we continue to see when you think about a market like that. I mean, you get big dispersions of returns across sectors and across stocks, and that's really the market that we've seen so far this year, where there's been a small select few that have really driven the returns, and it's really come out of those big large cap growth, large cap tech type of names out in the marketplace. And that's been the driving force. The big overweight within the S&P 500 is technology. Is that still the largest sector within the S&P 500 at about 25% of that index? And by way of the market cap weighted nature of the S&P 500, those have been, those big cap stocks are really the ones that have driven the returns. And even I think it's interesting when you look at just the S&P 500 versus the S&P 500 equal weighted, there's still a pretty big spread there of about 9 percentage points of differential of the S&P 500 being up almost 4% this year. But those same 500 stocks, if you equal weighted all of those, that basket of stocks is down about 5% this year. And again, that is just speaks to leadership characteristics that we've seen out of those big cap names. Not to say that other areas haven't done well, but it's really been the big cap names that have really held up better and driven this market to now, Steve. As we're looking at the S&P 500, that have driven this market very close to getting back to all-time highs on the S&P 500. We added another X on the 20-point chart today, but within about 1% at one point of the S&P 500 being around that 3390 level, which we got to back in February 19th to be specific. But as you were, the price action on the S&P 500 is taken. This again is the 20-point chart on the S&P up to 3360, adding another X to its chart today, intraday basis, as the S&P right now, as we are recording this at about just after 1 o'clock Eastern, up about 25 basis points. The Dow Jones, interestingly, is up over 1%, while the Nasdaq is pulling back a bit today. But when we look, at the S&P 500 in terms of just some perspective, in terms of looking at number one, upside price targets. Obviously, the first upside target that we're looking at on the S&P 500 specifically here is that 3380 level, which would match the 20-point chart high. With the S&P 500 ultimately getting up to 3390 on its default chart. So that's just certainly on the upside there. On the downside, when you look at the S&P 500, in terms of just where we might see some support come in the event of we see some kind of pullback or breather in the market, the 3220 to 3200 area will be an initial area of support. That 3220 was a breakout level for the S&P 500. Previously, that was some old support. And then a shorter term perspective, you see some support from there down to about 3200. After that, you're looking in the 3120 to 3140 area. So just some levels to keep in mind there. As we move through the coming days and the coming weeks with respect to this market. But as we mentioned last week, another one of the positive developments that came out of the S&P 500 that we haven't seen throughout this year really was a move back to positive monthly momentum for the S&P 500. And the monthly momentum is certainly a bit of a longer term view of moving average comparisons, where we're looking at basically a 1 month moving average versus a 5 month moving average. And essentially, if the 1 month crosses above the 5 month, the monthly momentum is positive. And if the 1 month crosses below the 5 month, then the monthly momentum is said to be negative. And so typically these things can trend for some time, on average about, once you see a move back to positive monthly momentum, tends to stay there for about 6 to 8 months. Similarly, when you see a move to negative monthly momentum, that can last for 6 to 8 months. Most recently, you saw that cross negative at the end of February, and that lasted about 5 months until the end of July, when it moved back to being positive. So that is certainly something more of just confirmation, something that is under the perspective of another positive for the market, and specifically for the S&P 500, that monthly momentum turning back to being positive is certainly a good sign. And these monthly momentum readings, we calculate these on indexes, but on individual ETFs, on individual stocks, mutual funds as well. So these can be helpful just in terms of understanding where some of these momentum moving averages are. And this is monthly. Again, we do that on a weekly basis as well to provide a little bit shorter term perspective, which is a 1 week versus a 5 week moving average. And then even very, very short term is daily, but the monthly is going to give you a little bit longer term view there.
I just wanted to make a point on the S&P 500 chart, which is also, as the market moves into these, breaks through these particular resistance areas on the top side, we've had some pullbacks on each one of them. And as we, go to challenge the market high of many months ago, there could be a chance of that being a challenge or a testing area. Where those of you who are looking for some modest pullback, maybe we'll see that as we make that new high and try to break into new territory. So you can look for possible modest pullbacks to continue to gain entry into the more favorable relative strength areas. Back to you, JG.
Yeah, it's great, Steve. And as we kind of move forward and talk about the relative strength picture, one of the things that we mentioned at the beginning is Dolly and dynamic asset level investing. For those of you who are not familiar with our Dolly ranking tool, but basically what it's designed to do is identify leadership trends across asset classes, as well as drill into individual asset classes. Just over the course of the past week, we saw domestic equities for the first time since March move back up into the top two rankings, and fixed income still holding on to that number one spot as domestic equities moved up moved up above cash. And that we recently entered the decade of the 2020s here this year, and as this market is certainly off to quite a volatile start to the year, to the decade. But you go back last year in the 2010s, what we saw is about 89% of the days, so that being from basically 2010 through the end of 2019, about 89% of the days domestic or U.S. equities held on to that number one spot, while cash never made it up to number one during the past decade. Even fixed income, only about 4% of the days was fixed income ranked number one. That's obviously very different than what we've had started off this year, just 6 months in, this data through June, but just over a third of the days so far this year, domestic equities has been ranked number one. Cash has held on to it for a majority of the time. Very different picture, really. You go back to the decade of the 2000s, and the 2000s was a decade that was very much all about international equities, commodities, emerging markets, even small cap U.S. to some extent. But by and large, it was a lost decade for the S&P 500. And we saw about 4% of the time domestic equities were ranked number one. So I mentioned this just to say that when we go through this market and identify these leadership trends, when something moves up to the number one and even number two spot, those top two areas, those are notable changes for those of you who are utilizing Dolly to drive portfolio decisions. Certainly taking an increased equity exposure is something that is reasonable inside a number of model portfolios that we run that are driven based off of Dolly. We have seen and will see some changes to the increased exposure to equities here last week and in the coming weeks as well. And that has one of the things, when we go back and we look, obviously the market has seen a rather notable move off its lows, which are go back to March 23rd. Coming into this year, U.S. equity was in the number one position within Dolly, and that had been the case since about August of 2016. Not unlike what we saw this year, obviously not virus or pandemic related, but at the beginning of 2016, you had a very similar amount or similar type of volatility, not the degree to which we saw this year, but back then you had a lot of volatility around the markets, around the Chinese market. You had the Brexit, you had Greek defaulting on debt, a number of just risks out there in the market that caused the sell-off, caused U.S. equities to move out of the number one spot for about 6 months until August of 2016. And then August 2016, U.S. equities moved back up to number one and stayed there again for almost 4 years until March 13th is when U.S. equities went from a number one rank to the ranking of number three, and fixed income and cash took over as the top two spots. And so domestic equities ultimately fell to 4 by the end of March, and then began its improvement to now being back up in the number two position. And so, as we go through it, it really was this, an interesting picture when you look at the domestic equity tally signal, which is the number that you see there within Dolly, versus the cash signal. And again, the blue line represents domestic equities, the yellow line is representing cash, and coming in as a very big lead for U.S. equities. March 13th, you see those two lines cross, and the domestic equity and cash ships cross paths until about early April, when that spread, the difference between the cash signal and the equity signal was at its peak by early April. And then basically over the course of the past 4 months, we've seen this narrowing of the gap until on the far right-hand side, we now see that cross back above. And so this is just kind of some zoomed in perspective on the domestic equity signals versus the cash signals. And really, when we zoom out and we look back till the end of 99, this has really been, the fourth market environment where cash was even above domestic equities, going all the way back basically over the course of the past 20 years now, 20 plus years. The first to the far left-hand side there, where you saw the cash, the yellow line, cross above the equity line, was back at the end in the 2000, 2001, 2002 time period, where cash remained above U.S. equities for a good chunk of time, obviously as the technology bubble bursting back then. Then the second period of time was the 08 to 09. So for about a year, from July of 08 until May of 09, cash remained above U.S. equities. May of 09, it crossed back. So domestic equities by May of 09 got back above cash, stayed there all the way until February of 2016. Again, that 16 time period, you got some volatility about 6 months, and then equities ultimately moving back above in August. And so, there's basically been four events over the past 20 plus years where cash has been favored over domestic equities from a Dolly tally perspective. The first two, obviously, having risk management in place and reducing equity exposure during the 08-09 market, the 01-02 market, certainly benefited the portfolio, the 2016, and now as this one has crossed back above, by reducing cash exposure in mid March, it is certainly something that didn't take any advantage or didn't advantage the portfolios in any way by reducing equity exposure. What we have seen, though, historically, regardless if it was a protracted bear market like an 08-09, or whether it was a early 2016 time period, when domestic equities move back above cash, it has historically been a positive, prolonged period of excess return out of the equities market going forward. So, all of that being said, that would be seen as another positive sign for the equities market, as domestic equities tally signal is now back above that of cash. And those are, consistent with things that we're seeing in other areas, Steve. Not only is Dolly seeing equities back in the top two spots, but, you look at asset class group scores and you continue to see some positive signs out of equities there.
Yeah, JG, we sure do. Let's kind of run down what we know, which is the core of the U.S. market, represented by the S&P 500 related funds. Still has a very strong ranking. We're at the 88th percentile, getting near the 89th percentile against all asset classes around the world this week, and that's a kind of a pop up from near 81 as we're moving into August, and so there's been some strengthening in that core along the way. I'll make a mention that the overbought, oversold nature of those particular funds, the S&P 500 related funds that are in that cloud of symbols that we read, the overbought nature is fairly moderate, about 62% overbought. But on a end of day fund pricing, that's still moderate, because we might see overbought readings of 150, before we start to get extremely concerned or concerned at all. So I think we're still in a modest overbought range, or you could say not overbought at all with that core. Jay mentioned the lost decade, and I think that's important to tie back in here, is that lost decades are highly correlated to low core percentile rank readings. The reason for that is most firms project asset allocation guidance based on the strength of the S&P 500, being presumed that it is very strong, and therefore the portfolios are always overweighted to that high large cap market core, as a rule of thumb. So if you lose the pressure, in other words, the positive pressure in the U.S. core, and you're working on firm guided allocation models, well, they're going to underperform, and in the case of the 2000s, underperform in a big way. The counterpoint to that is just because it's a lost decade for those that are relying on large caps, it's not a lost decade for Dorsey Wright, for you as the advisor using Dorsey Wright tools, and in other words, our culture, because when the core loses dominance and pressure, we move elsewhere. there are other areas around the world to move to. That can include other types of equities, and certainly could include other types of fixed income, and certainly, that could strongly imply we move to non-U.S. weightings. So there should be no lost decade for the Dorsey Wright models and the advisor following the Dorsey Wright principles as we go forward. So that's encouraging news. At present, though, the core is very strong. And so, everyone's doing well, you could say, the firms and you and the rest of us, and that percentile rank is, still holding in good. The money market percentile rank's been dipping, as we've moved from mid-July into here a week into August. We've got the money market percentile rank hanging down near the 11th percentile. That means that money market is only stronger than 11% of the asset classes around the world. Another way to loosely say that is 90% of the asset classes around the world are functioning stronger than cash. And so there's a lot of asset allocation preferences there, both equity, fixed income, a lot of things to be doing. And I think that's important as a key tone to say that's another positive as we move in, through August and we head towards September, is there's a lot of asset classes functioning very well, and the core readings are strong enough to feel some confidence in going ahead and playing offense, as we make our way really one more month down into the summer. And of course, the ultimate goal here in the short run is to make it through November, which is another seasonal quarter where we do some major updating on fund score models, but it's still a good target to have. So from here towards November, I could say I don't actually know what will happen each month, but the core reading and the money market readings are in such a case that we're certainly thinking offense. The last point I'd like to make on this macro view of asset classes is to give some deference to the all fixed income camp. Keep in mind that the all fixed income camp, which ranges from U.S. dominated fixed income, but some non-U.S., some currencies, and then high yield and all kinds of wonderful asset classes. The net score of all fixed income is near the highest levels we've ever really printed a tape on at Dorsey Wright since asset class group scores have begun. So you're running a very good pressure, meaning positive action in the fixed income camp as well. And so you're actually witnessing and you're partaking in a market which is rewarding both the proper equity relative strength allocation as well as the proper asset class and fixed income asset class tranches that you'd be using in your asset allocation model. So in other words, there's reward on both sides, and quite frankly, that's one of the reasons why balanced funds are doing so well in this market environment, because they have both the equity and the fixed income component. But I think you have a lot of pistons firing in your favor as the advisor. And so again, continue to look at this market landscape as offense for equity, offense for fixed income, and continue, to move down the road. Back to you, JG.
Steve, you bring up a lot of good points, and obviously there is, very clear defined leadership in the core equity market, the S&P 500 related funds, and you look at a reading of almost 90%. Certainly very, very strong, but there are a lot of things that are working underneath the surface. And so what are some of those things that you're seeing in the asset class group score world that are seeing the most improvement underneath the surface?
Well, we're back to this score direction alignment in the asset class group scores view. And the reason we use that, we've been using that for, well over a month, is to really look at the disparity, who's improving more than others, where's the greatest improvement. And I think that, this is helpful as we're coming, off bottoms in this context, where's some leadership there and improvement. And what you notice is that the precious metals and the materials are still, in the top two slots. Emerging markets, which is that non-U.S. component, is still up there, showing a lot of improvement. But what I wanted to do this week was make an honorable mention for microcaps, which are now, the third most improved group on the entire system by score direction, which means, how many points in score has something improved, from a recent low reading. Now, microcaps got hammered hard in the March sell-off to where the low score reading for microcaps got to a 1.16. We mentioned this before. I'm just going to mention it again. That's a very low reading for an asset class on our entire system that's not sector based. But as you know, microcaps are highly sensitive and do carry a higher standard deviation. But the group has moved up from a 1.16 all the way up to a 3.79 score. So that qualifies it to have a score direction of 2.7 on the upside. And again, puts it in our face to say this is one of the most improved groups on the system. Now, as I may have mentioned in prior calls, this doesn't mean that you necessarily are comfortable with microcaps, although you could be. But I think it's important to say that the microcaps are expressing themselves very strongly, and they're kind of the canary in the coal mine. When they start to fade and break apart, there's trouble in the markets somewhere, and they typically evaporate early. And when they pick up some steam and they're doing well and there's robust scores, that also tends to suggest there's a broad market, a wide market, and there's a lot of participation for at risk or risk on type of approaches. So what that microcap climbing tells me is there's a lot of investors, there's enough investors to say, hey, I've probably got my large caps, I've probably got my fixed income. Now where else can I go? I picked up emerging markets. Now let's go down the food chain and let's pick up some high risk, high return type groups. And that's, I think, what you're seeing here with this microcap evolution. It's part of the Kickstarter that the small caps are doing, where a lot of small cap actions, even small value, has picked up some score points over the last few weeks, or you could say 3 weeks, and that small cap contention is really helpful. What that tends to suggest is that the equal-weighted S&P 500 will start picking up some speed here. The reason is because the equal-weighted S&P 500 does have a correlation to broad market strength, which is highly connected to small cap strength. So by one measurement or another, we lead back to the equal-weighted S&P 500 should perform better from here, although as we made note today earlier on this call, has not performed as well as the large cap weighted S&P. But those pistons are starting to fire up here, and so that gives us something to continue to use. For those interested in historical types of perspectives, is that the equal-weighted S&P 500 is usually in control with the higher score 70% of market chronological time, and the cap-weighted S&P is usually in control about 30% of chronological market time. And you would say, we do expect the equal weight to regain a dominance. Also, I would mention that holding both in some sort of rank weighted format, meaning whoever in the lead gives 60% to, whoever's at the tail give 40% to, between these two, is a great game plan. It tends to smooth out the return profile. It smooths out the standard deviation profile. It allows wins to come from either camp, the equal weighted or cap weighted camp. And I think it's a good idea. And if you're, if this is the first time you've heard something like that, just make a note that, there is a good use case to say cap weight, equal weight. How do I use these two inside my allocation, to take advantage of what the market's doing at present? The cap weighted S&P is in the control. But we also see that the small cap, the elevation in the small cap, the elevation of the broad market offense, is pushing the equal weight, bringing her back to, get alongside and be a good solid citizen again. So I hope those are some good ideas to consider. But the score direction sheet and the view that the slide we're looking at now does still tend to represent, a broad range of improvement. There are more groups that have improved more than a full 1.5 score points, or over a point that I can count. I can't count how many groups have excellent score direction, and so that gives you, again, one more feather in the cap to say, hey, I've got an offensive tone here. Yes, it's the summer. Yes, it's the seasonally weak cycle. But we want to take advantage of that offensive tone. Maybe there's some pullbacks, maybe they're not. But whatever the case, you want to take advantage, of this breadth in the market, because I really think that helps out the total allocation. The total allocation, some months ago, you used to think, well, it's got to be one bond and one large cap stock. But what the score directional sheet is showing us for sure is that this game is much broader than that. There's a lot of things we could do and a lot of things that could benefit the allocation. JG, back to you.
Yeah, and it goes even Steve, beyond just equities. I mean, you see some beyond just U.S. equities, you see some non-U.S. stuff up there that has been improving. But even outside of that, when we look at other areas, specifically commodities, you see precious metals, materials doing very well, and also while not showing up on the group score page, you're looking at a chart, just a price action chart of crude oil itself. Recently moved back into a positive trend at 42 for the first time since back at the beginning of this year, since January of this year, when it moved into a negative trend back around 53. Obviously, had a ton of volatility with respect to crude oil, but has given now another buy signal on the chart, crude oil at 43. So, even when you look at other areas, commodity related or commodity specific areas like crude oil itself, this is going to certainly benefit and help most commodity related benchmarks, as the big commodity benchmarks tend to have the greatest exposure towards energy, because they're, like the S&P 500 is cap weighted. A lot of broad-based commodity indexes are production weighted. So crude oil, energy at large is going to just occupy a lion's share of the exposure within those. There are also, a number of ways out there to gain exposure to crude oil through funds and through ETFs, all doing so with slightly different futures contracts. So there's a number that look to hold mostly front month futures, some ETFs out there that hold all 12, and then some that look to optimize the roll yield, such as to try to alleviate any of the negative impacts that rolling has on the futures contracts and any kind of slippage there. So, if you're looking for ways to gain exposure to crude oil through, an ETF or something like that, there's a number of ways to do it. If you have any questions about it, please, don't hesitate to give us a call. Happy to talk through any of that with you in terms of the structure of the products and some things to be cognizant of. But nonetheless, we're seeing crude oil, this breakout in crude oil come at a time where we've also seen the U.S. dollar has been very weak here of late. The dollar's down about 10% off its highs, which is a pretty big move for the dollar. But it is also, when you see a weak dollar environment like that, some of these other areas do benefit from that. Something like crude oil, something like non-U.S. equities, they are certainly benefited by a weak dollar environment. So that's a lot of the themes that we've seen here. Certainly can tie back into the picture that we've seen, a weak one that is on the U.S. dollar. So with that said, before we wrap up today, Steve, you mentioned a number of model updates. And for those of you who are following any models that we have on our website, there's a number that are monthly models, like a large cap core model or ESG model, stock models that we have on the website. All of those models just updated at the end of July. So if you have not taken a look at those changes on the models page, be sure to do so. Also, in terms of models, this being a seasonal quarterly evaluation for all of the FSM models that are quarterly. So those all just got updated and reviewed last week. So I think we touched on it in last week's call, but if you're following any of the FSM models that use the seasonal quarter to evaluate on, be sure to take a look at those. I use one of those, and then saw some changes in one of the models within our 401k plan that came out just last week. So be sure to take a look at those and make sure that the models are kind of in line with where your current holdings are. So with that, like I said, if you have any questions, comments, concerns, you can reach us. Our phone number, email address right there on the screen, 804-320-8511. If you don't have access to our website and would like to set up a free trial, please do so. You can click on the link right there to set up a free trial. of the service, and we can have a demo set up for you, a personalized, customized tour and walkthrough of the website. So with that, as always, we really appreciate you taking time out of your day to join us to hear what we have to say. I know it's, your time is the most valuable resource these days, so we do really appreciate it. So with that, thank you all for joining us this week, and we look forward to talking to you next week.